Hi, and welcome to the Stock Scores Market Minutes for April 25th, 2016. This week, let's talk about using stop loss orders. Now, I believe as a trader, it is absolutely critical to your success to limit the size of your losses. I've seen too many traders sitting on big losers in their portfolio that outweigh many winners simply because they lack the discipline to limit the size of their losses. At the same time, it's important to do that limitation of losses at the right point. And if you're using a stop loss order, that means putting it at a place where there is strong support, using the chart, using past price activity to determine the stop loss point. The problem, however, is that the market is not perfect and stocks can move through support before rebounding. You have to remember, in our market these days, we've got algorithmic trading engines, computers that will push stocks down to what are known support levels to trigger stops, clear out a bunch of stock before moving the stock back up again. And so for that reason, I prefer to use the soft stop concept most of the time. It's important to watch how stocks behave around support. Too many times, even just this month, I have had positions where I have been taken out by a stop only to have the stock reverse because I didn't give the stock just a little bit of wiggle room, both in terms of price and in terms of time. So keep that in mind when using stop loss orders. All right, let's get into this week's analysis. Here is the 30-day, 60-minute chart of the S&P 500. And you can see that we are in a very nice upward sloping channel. We fell back a little bit on Thursday. We're now near the bottom of that channel where prices should bounce and continue higher. If they ultimately break the lower boundary of this upward trend line, at that point, you will need to get more cautious short term. But for now, this remains a bullish chart. Looking now at the weekly chart of the S&P 500, you can see that the downward trend line, I didn't draw that very well, has been broken, and we're now moving up towards these horizontal lines of resistance. There is a lot of very important resistance that the market is bumping up against right now, and therefore expect that the buyers will be tentative, that they will stall, that this upward action that we've seen is lacking confidence right now. Now, that doesn't mean that it's over. We could ultimately break through this level, but I do expect the market to stall here for a little while first and possibly reverse. Now, one argument for the bulls is this strength in the small cap stocks, which have also broken their downward trend line, but they have much more room to go to the next levels of horizontal resistance. And so I think we may see some money rotate out of the larger caps and into the smaller cap stocks. We've seen this past week biotech doing quite well. That, of course, was one of the leaders of the small cap market in the past. The TSX 60 on the 30-day, 60-minute time frame is now in a nice little upward trend, upward sloping channel here. We're at the bottom of the channel, should resume the upward trend next week as long as oil and gold, or at least one of them, can continue to show some stability and strength. On the longer term chart, I like it. It is breaking through resistance from a rising bottom after breaking the downward trend line. That points to the Canadian market moving higher. I am now bullish on the Canadian market. Speaking of bullish, here's a great bullish trend for the TSX Venture. Only problem here, a little overbought. We're way up at the top of the channel, far above the upward trend line. And so I expect in the near term to see prices move back to that trend line like it did in March. Now, it can move back either by going down or it can move back by going sideways. But right now, a little overextended, a little too exuberant. But I do think that this market deserves attention after so many years of being ignored. U.S. Treasuries, this, of course, is what tells us where interest rates are going. It went down this week in pretty substantial fashion, one of the bigger down weeks we've had in a while. That means interest rates went up. It has not broken the upward trend. It has not broken the bullish pattern that came with that pennant breakout back in January. So at this point, it's just a little bit of caution, but we are seeing this little double top forming at a falling top. And so, more so than last week, I feel a little bit more bearish on the U.S. Treasury bond market, which means a little more bullish on interest rates, expecting them possibly to go higher in the near term. One of the critical things for the market, of course, is always the U.S. dollar. I like to use the UUP ETF for charting the U.S. dollar and for trading it if you like. Right now, we have pulled back to support. We've touched it so many times in the past. Real strong support right here for the U.S. dollar. We bounced a little bit this week, but the bias here is pessimistic. We've got falling tops on that chart, and that points to maybe a breakdown through support, weakness in the US dollar, leading to strength in some of the global currencies. And what we've noticed, of course, recently is the Canadian dollar, Australian dollar doing well, not because the Canadian economy is doing great, but more so because the US dollar is showing some weakness. On the gold side, these things benefit from a lower US dollar, gold, commodities, oil. And we see here gold still locked in this little flag pattern. It's a bullish pattern because the trend is up into that pattern. What we now need to see is a break up from the flag. It tried early in the week, was kind of timid, ended up pulling back later in the week. I still think this is a neutral chart, but it's got some promise simply because the downward trend line was broken some time ago. On the oil side, we had some strength despite so many negative things that you hear about in the news, in the media. Oil continues to stabilize and move higher. I still don't think it's a super strong chart because we haven't made that strong, decisive break from this rising bottom that is forming. It sort of tickled through resistance this week, but it didn't make an authoritative, spike up from that rising bottom. And so at this point, I still think some caution is warranted, but certainly things are improving. And what I do like is how the energy stocks are behaving. They've been a real leader lately. Fear index, the VXX, which of course represents the VIX short-term futures. Those are futures on the implied volatility of the futures on the S&P 500 futures contract. Really at some big lows here. Now, a little deceptive when you look at the chart of the VXX because there is some time value decay. So don't think that because it's approaching this support level that it's due for a bounce. The value of the underlying VIX here is different than it was back here because of that time value decay. Either way, the point of this chart shows that investors really have no fear right now. They're feeling complacent, and that's a little worrisome to me. I think that it could lead to a spike in volatility as someone's all runs for the exit door at once, but still no sign of weakness or critical weakness in the market. So US stocks neutral long-term simply because it's hitting that long-term resistance where I think it will stall. The trend is up in the short term, so we have to remain bullish. Canadian stocks bullish with two L's, of course, both short and long-term. And I can't remember the last time I was bullish short and long-term on the Canadian stock market, but certainly things looking better there. In the gold market, I've got neutral ratings, maybe a slightly on the optimistic side because the short-term trend is up. We're just stalling right now in that group. Oil, also neutral on both time frames, but again, we get a little break from that rising bottom that oil is in now, and this will go bullish very quickly. So what we see right now is that when one market group fails, another takes the lead. We had strength in financials, then they went weak for a while technology did better. Now this week, technology got weak and the financials took the lead. Of course, energy also taking the lead right now after being weak for so long. So it's really a case of that there's so much money floating around. You have central banks pumping money into the world, and that money is landing in stocks. And it's just going from one group to another, whether it makes sense or not. Canadian markets are starting to play catch up as the commodities stabilize. They've actually been the better performer in the last few months, and they continue to improve with commodity price stabilization. U.S. markets are hitting that strong long-term resistance. No sign of weakness yet, but we just know that markets tend to stall when they rally into resistance. The VXX shows the market is complacent, having no fear, and that perhaps is the biggest worry of all. Well, that has been the Stock Scores Market Minutes for April 25th. Make sure you follow me on Twitter, subscribe to this YouTube channel. I'll see you next week with this video. Have a great week in the market and trade well.